We've seen more and more practice owners turning to loans to fund expansion or just tight cash flow. Some of these loans are straightforward, like an SBA loan or a loan from your local bank. Others, like merchant cash advances or MCAs, have a lot of hidden costs that can quickly and quietly drain your cash flow for months or even for years. So, here's what to look for before you sign anything as far as loans, financing go. I'm going to end with 3 questions you can ask, but first I'm going to give you just a quick landscape of the loan environment. So, what are your options? First of all, kind of the most trusted option is SBA loans, right? These come from the government, the Small Business Administration. They're usually going to have lower interest rates, longer terms, more paperwork. It's going to be a much longer process. So if you're in a cash crunch, this is usually not going to work because it's not going to be here in time. But that is the most trusted, respected, probably lowest cost option. Next to that, we have traditional bank loans. So you go to the bank down the street, basically you're applying for a loan with them. The rates are fine. They're going to be kind of like the market rate. It can be hard to qualify sometimes, especially if you're a newer or lower revenue business. But those are fine. Those are a fine option. And then also we have, lines of credit, which are related to those traditional banks, usually going to come from them as well. That's more of a revolving line that you can pull from as needed, pull off throughout the year, pay off throughout the year, I should say. And then you usually have to pay it completely off once per year, depending on the situation. But let's talk a little bit about merchant cash advances or MCAs. These have really exploded onto the scene. They're super fast, super easy, but also super expensive. There's a lot of fees and super high interest that you're going to pay on these. And it's all kind of packaged up in like a really nice, beautiful package that makes it look really easy, but it's actually very pricey. These also are coming from a lot of kind of trusted sources. So Stripe does MCAs, QuickBooks does kind of a form of MCAs. And then we have some, really common ones like On Deck. You've probably gotten mail from them. I know I have. And emails, Itria Ventures, other ones that we've seen with multiple clients, lots of MCAs being offered. So what is an MCA actually? What's happening is the company, the lender, is advancing you cash in exchange for a portion of your future revenue. So how this is different from a normal loan is the fee, basically the interest, is baked in up front. It's not calculated as an APR of, like 6% or 5% on the principal. The fee is just baked in right away. So if you're taking out, 26,000, they might bake in fees, and all of a sudden now you're paying 29,000 or 29,500. So you're paying 3 to 3,500 in interest on top of that 26. Many owners that we see do not realize how high the APR is that they're actually paying on this because it's just packaged differently. The fees are right in there. They're not going to show it in quite the same way. They might use some different metrics and numbers. And oftentimes, unless you look really at the fine print of the loan agreement, it's really hard to know exactly how much you're paying until you kind of get into it and realize that, wow, most of what I'm paying back right now is the fees or the interest, and I'm not making much of a dent on that principal. So this is super tricky because these MCAs can get into your account very quickly. They can come kind of solve the problem right away. But oftentimes what's happening is they're actually creating longer term problems, such as just kind of getting in that cycle of always having to pay back an MCA, right? You take one out, it's high interest, so you're paying a lot more than you borrowed. And now you need to take on another one to cover your cash flow and to cover the interest that you're paying back. And it kind of continues and continues. And we've seen this with multiple practices. So you do want to avoid these, I would say, just to put it, as clearly as possible. I understand sometimes this is the only option. So if you do take these out, you want to be very careful with them. There's a couple things to think about on the bookkeeping perspective, as far as like making sure interest and principal are separated. That's a little bit of a separate conversation, so I'm not going to get into that, though that is important. And we do see a lot of loans entered really incorrectly in the books, which can really cause havoc when you're filing taxes or just lead to you not getting the deduction that you should. But here's the 3 questions really that you should be asking yourself before you sign any financing paperwork. Number 1, what's the total amount that I'm repaying versus the amount that I'm borrowing? So if I'm borrowing $1,000, that's the amount that's actually getting into my account. What am I actually paying back to the company? Am I paying back $1,300, $1,500, $2,000? What am I actually repaying? And from that, you can pretty quickly start to see, man, I'm paying back a huge amount of fees compared to the money that they're actually giving me. And that's probably pretty different from if you took that money from an SBA loan or traditional loan or something like that. Number 2, what's the effective APR? Meaning, what are you actually? What's the interest actually going to look like on this loan, right? What's that look like as a percentage? When you get it down to an APR percentage, you're going to see a little bit more of an apples to apples comparison. Where you can see like, oh, the SBA was 5%, traditional was 7%, and I'm paying 50% with the MCA. That's where you really see, wow, this is super expensive. And the other question, and this is just a question to ask, whenever you're taking on any financing, is if my revenue drops down 10, 15, 20%, am I still going to be able to repay this? Or is my cash flow going to be at a place where I literally can't? You want to make sure you have a plan there, because especially with private practices, revenue jumps up and down all the time, right? So we want to be careful about making sure that if our revenue drops down, will we still have the cash flow to pay this? Because like I said earlier, oftentimes when you start taking out MCAs, you can really get into a cycle of having to take on more and more MCAs to keep your cash flow going. MCAs definitely kind of are into the range of a predatory lending version. I'm sure that a lot of companies would not say that, but be very careful with these. And if you need a second set of eyes to look at these, that's exactly what we do in our monthly consulting meetings with clients. Is we're looking at these terms, making sure it's the right choice before anything's getting signed. Here's a call to action for you. If you have any loan documents that you're looking at right now, you're thinking about taking out an MCA, you're looking at a couple options, I'm happy to take a look at those, even if we don't work together. A second set of eyes can be invaluable. Again, I'm not, a legal expert or anything like that here, but just running the numbers goes a super long ways. So send over anything that you need to. Nate at navigatorbookkeeping.us. I'm happy to give you a second opinion because I don't want you to get in a place where you're paying a 50 or 75% APR. I even saw online, 200% APR. It can get crazy out there. So be careful, be smart, and hopefully this is helpful.